Okay, so good morning, ladies and gentlemen. Thank you to everybody who braved the cold here to come out today. We've unfortunately had quite a lot of cancellations today, as you can see. Obviously, we've got, for those of you that aren't in Johannesburg, it's a very nice, cold, rainy day. But at least we've got quite a lot of people on the webinar tonight, which is really, really good. Sorry, this morning. I'm used to doing this in the evenings. Anyway, so today, just before we get started, for those of you that are online, there is a Q&A box. Please don't type anything in the chat. I'm not looking at the chats, questions and answers. You're more than welcome to type your questions and answers. For those of you that are here, we'll obviously take these questions live. You can just raise your hands. We will have a proper Q&A session at the end. If there is something urgent, if you've typed something in the Q&A, or if you're raising your hand for something urgent and it's related to what we're talking about, I'll try and answer it there and then. Okay. But other than that, let's get started. My name is Ridwan Mullah. I'm from Think Markets, and today we're going to be talking quite a bit about wealth creation. We're going to be talking about trading and investing and how that all contributes to wealth creation and why it's so important as well. So I'm going to spend quite a bit of time, just by the way, today on about investing and why investing is so important. We're going to cover a little bit on trading, and then we're going to talk about trust, because that's going to be the most important thing for today. Okay. So let's dive in. For those of you that have been to webinars and events that we've done before, I'm sure you're getting used to the slide that's coming up, which talks about wealth creation, talks about investing, talks about trading, and it talks about savings. And what exactly is all of this? So first and foremost, the understanding that you need to have is investing. We, as South Africans, are notoriously bad at investing. We are notoriously bad at savings as well. And we forget that this is exceptionally important. What we love doing, and especially the younger generation love doing, is they love diving into trading, hoping to make some very quick money. So if you're on this webinar and you're hoping that I'm going to tell you how to make money very quickly, well, you came to the wrong place. But I will tell you how to make money today. And I'm going to tell you how it's going to take time. It's not going to be an instant gratification. Okay. But just to cover these three things, because these are very, very important aspects that you need to understand. First and foremost, savings. What is savings all about? Now, savings is where you're putting your money in a savings account in your bank, or you're putting it in a short-term deposit, notice deposit account. The thing with that is that you're earning interest rates quite low, even though interest rates are going up, and we'll talk about inflation and that later. But the most important thing is savings does not give you a good interest rate. If you're lucky, you get about 4%. And well, inflation, as we all know, the inflation recently came out at 5.9%. So what does that mean? If your money is growing at 4%, but inflation is 5.9%, it means you're losing close on to 2% on your savings. Your money isn't growing. All right. Now, if that is the case, savings isn't going to be a very good thing to keep your money. But the important thing of savings is that it's there for emergency. It's when something happens. As we saw in 2020, we had a pandemic. A lot of people lost jobs. A lot of people didn't get paid because businesses were closed. And that's where the savings comes in. Rule of thumb, they always say try and have at least 3 months of salary in a savings account. If you can do that, you know for a fact then at least 3 months you're covered for without touching any investments, trading, or anything else. You're not diving into anything. You don't have to sell cars, houses, and everything else. It gives you time. Okay. The next thing is investing, and this is where everybody makes the mistake. We all forget to do investing. And investing is most probably the most important part. Investing is about a long-term return. It's about putting money away today and looking at it in 5, 10, even 15 years time, or even at retirement. Now, that doesn't mean just take your money and stick it into a retirement annuity or something like that. It's about actively managing your future. And that's where it comes into. It comes into buying shares, buying exchange traded funds, which we'll talk about today. But it's about growing your investment over time. If you don't, you're going to end up in the same cycle that our parents have been in, whereby they are hitting retirement and they can't retire. There's nothing there for them to retire because all the money has been put into things maybe like an RA or a unit trust, and that thing hasn't performed because most people today, if I were to ask you, where's your RA? Everybody will either answer, oh, it's with Liberty, Discovery, or Alan Gray. And that's not the answer. The answer is actually most of it is sitting in the stock market. Where in the stock market? You have no idea. It could be invested in, I don't know, it could have been invested in Sasol when it was down at 30 Rand and now at almost 400 Rand. Then it's perfect. Your RA has grown. But it could have been the other side. It could have all been invested in Naspers at 3,000 Rand, which is now half the price. And that's the problem with things like RAs and the likes, is that we invest in these things and we actually don't know what it's doing. And we hope when it comes to retirement, we're going to have enough money. And then we find out, actually, we don't. And a lot of people dive into an RA and go, oh no, I'm putting my money in an RA because I save on taxes. Well, we forget also that when we do retire and the RA starts paying out, well, you're going to be paying taxes then. Okay, so you may save it now, but at a later stage, you're still going to pay for it. One thing in life, you're never going to avoid tax. Okay, the rule is tax and death, the two things you won't avoid. Okay, but we're going to spend some time today on investing and why it's so important. Next is trading, and most probably a lot of people here today are here because of trading. Most people don't know that Think Markets offer you both trading and investing. We have a share account, which allows you to invest into the stock market on the JSE and soon even overseas. And then we've got a trading account called the CFD account, and that is where trading comes in. Now, trading is a short-term thing. You're not buying a CFD share or FX or a commodity CFD commodity or even a CFD crypto to hold it for the next 10 years. It's there for the short term. We are buying and selling or selling and buying, so going long or short. And we're doing it for the short term. You're trying to get money or make money, from the fluctuation in price, whether it's going up or down. And that's the nice benefit of trading, is that when things are going down, you can still make money. When share prices are falling, when the FX rate is going from 1670 all the way now down to 1590, you can make money on that. So you can do that. But like I say, trading is for the short term. To give you a very good example, what I do is, and I mean, I've been in this industry now, plus 15 years, I think, so I'm giving my age away. But for 15 years, I mean, the one thing I learned very, very quickly was build the investment side and then start building on the trading side. And we'll talk about it a bit later about, especially when you get to trading, about hedging, how you can actually hedge your investment portfolio even through trading. But it's again for a short-term period. So with that said and done, let's get into investing, because this is what I really want to focus on. So what are we investing in? When it comes to investing, we're going to be talking about the stock markets, your normal share market, stocks, shares, ETFs, ETNs, and the likes. Now, what exactly is the share market? And this is where people sometimes get a bit confused. We're not talking about the FX market. We're not talking about any of those things. Here we're talking about things like the Johannesburg Stock Exchange. We're talking about the US share market, buying physical shares. In other words, investing in a company. And it's actually one of the most simple things around. It's a normal market. It works like anything else. It works, in fact, the easiest way for me to always explain this is I take you on a shopping trip. So what do you do before you go shopping? Okay, if you're like me, I hate shopping malls. So I have always a plan in place before I even get to the shopping mall. If I'm going to the shopping mall, it's very focused. I have, unfortunately, two girls. Fortunately, I have two girls and a son. And I'm going to use a very sexist statement. A lot of people say, women are not focused at all. When it comes to shopping, I have to disagree with it. I actually find my girls are very focused. They've been taught from a young age. We go to the shopping mall, you're buying a pair of jeans, walk in, buy the jeans and let's leave. Okay, that's me. So how does it work? Like everybody else, before we go to the shopping mall, we've done a bit of research. We're saying we want a pair of jeans. We know the type of jeans we want. You know, your size. Your waist may be at 22 or 32 or 42 or 62, whatever it is. And you also know the type of jeans that you want. You know that you want something maybe blue or maybe black or whatever color it is out there. You want a skinny, slim, whatever, geez, I don't even know anymore, straight cut, baggy, flared, whatever it's called. You know already what you've done your research on what you want, right? You go to the shopping mall, you walk into a store and you see the jeans you like and you decide on if you want to take it or not. But the first thing you look at is the price. So let's say you walk into Edgar's and the price of the jeans there, it's a Guess jeans, I don't know, whatever it is. And the price of the jeans there is 1,000 Rand. Do you immediately buy it? Or do you say, wait, hold on, let me go and have a look in Truworths quickly. Go to Truworths. Go to Truworths quickly, see the price of that same jeans. And that jeans is 900 Rand. Do we still buy the jeans from Edgar's for 1,000 Rand? No, we buy the jeans from Truworths for 900 Rand. I take the jeans, it looks right. I may try it on even, fit it, everything, make sure it fits fine. And then I go and I pay for it. Do I know who I'm giving my money to? Do I know the person, the cashier there, sitting there? I don't. It's an anonymous exchange, literally. I give the person there 900 Rand. They give me a pair of jeans. I go home and then I have to look after that jeans, right? Do I take the jeans, put it in my cupboard and leave it there forever? And you know what? I say, okay, fine, I'll go and look at that jeans in 10 years' time. No, I don't. I wear the jeans. It gets dirty. I wash the jeans. I try and make sure that it doesn't fade. I look after it, right? That's exactly how the share market works and how investing in the stock market works. You got to find the broker that is going to help you to actually place the trade. Now, if your broker currently is charging you 0.5% brokerage, and there's another broker charging you 0.25% brokerage, who do you go with? Okay, you go obviously with the cheaper one, and we'll talk about costs as well. The next thing is you've got to research. What do you want to buy? What do you want to invest in? What company looks good for you? And we're going to do a bit of an example today as well. Once you've decided on that, you decide on the price you want to pay for the share on the exchange, and all the trades with Think Markets are on exchange. And then if somebody's willing to sell their share at that price, you get the share. Now you have the share, you own a share of a company. What do you do with that? Do you take it and just leave it there in your portfolio and say, I'll come back to it next year? You got to look after it. Keep track of it. If you've bought Naspers, you got to monitor it. What is happening with Naspers? Everybody now today pretty much knows that if I buy Naspers shares, I've got to worry about what's happening in China with a company called Tencent. Right? Naspers also has exposure. Most people don't know it, but they also have exposure in Russia as well. They're trying to get rid of their company there that they own quite a bit in. You got to know that. So you got to look after it. If you decide that you don't want to stay with that share for whatever reason, just like your pair of jeans, maybe it got torn and that type of thing. When you throw the jeans away, do you just never ever buy another pair of jeans? No, you go and you look for either something similar or maybe you want to change up. And that's exactly what we do here. You don't take your money out of a market. You always keep your money in the market and you then reinvest in something else. Okay. But that's the share market. And what do I get out of it? I mean, if I'm going to own a share in a company, what do I get? Well, I get some nice profits in the form of dividends. When a company does well and the company makes profits, it has a right to declare dividends. So I get to earn some dividends. I get to enjoy the growth of the share price. Companies that do very well over the long term, the price increases. So I bought a share at 100 Rand. In 10 years' time, I'm very much going to be looking at selling that share maybe for 300-400 Rand. The thing that I used to love pre-2020, so pre-COVID days, was all big companies have what they call AGMs, annual general meetings. And the reason why I used to love these things is because as a shareholder, you get invited to these events. And when it's with the big companies like the Naspers, the Anglos, and all of them, they used to have some really, really great functions. A lot of free food, free wine, free champagne, even at some of them to celebrate big things and that there. So people used to love attending these things. Get all the free food and get a little gift and everything else. But the nice thing is also at that AGM, you get to hear about the company and hear about your investment. How they're doing, what has been good, and the leadership starts talking. And you can also start ascertaining whether the company has good leadership or not. Last but not least, you obviously get what we call the right to be informed, and that is through what we call the stock exchange news service. If any company is selling shares or there's anything that's going to really impact the share price, they'll publish it on SENS. And that's your news service. Okay. But the big thing for me is, well, that's all well and good, but what can I actually invest in? So currently, those on the right-hand side of your screen is every single thing that you can really invest in different ways and forms. You can invest in the stock market, which has large, medium, small, and penny stock shares, as they call them, or AltX here in South Africa. You can invest in property, and I'm talking about buying physical property. So you can buy a house, rent it out, or buy an apartment, rent it out, and make money from a rental income. You can go into debt, and I'm not saying you go into debt. So in other words, you can sell debt. So in other words, this is where you earn a fixed interest because somebody else has borrowed the money from you. So it's literally you are borrowing somebody money and obviously earning an interest back. And that can be done through bonds, preference shares, and the likes. You can invest in commodities. Here in South Africa, you can actually buy physical gold. You can even buy a Krugerrand. That's gold. Okay. Believe it or not, you can even today now, sorry, you can even buy little gold bricks. There's actually places that now sell it and they can get it delivered to you at your house. The only problem is when you want to sell it, yeah, you've got to find somebody who's going to give you a fair price. Good luck with that one. You can even invest, like we always say, in international assets. You can buy something offshore. You can buy property in Mauritius. You can do all of these things offshore as well. And then you can even buy into exchanges from around the world, the S&P 500. You can invest in that entire S&P 500 and everything else. Well, last but not least, you can invest in cash. You can do all of these things, and we all know about it. The scary thing is most people don't know that every single one of those items that I've listed there, you can actually invest in on the stock market itself. Property. You can invest in a company called Redefine. Redefine is most probably was one of the best companies around who used to pay, without fail, a dividend of just over 8% per annum, which means whatever you had invested, you were getting an 8% return on it. They've started again paying their dividends after 2020 and the likes, and they're paying some very good dividends. What does Redefine do? Redefine owns property. They own offices, they own even some malls and that there, but they're really big in the office spaces and the likes. So instead of me buying a house, I can buy a share in Redefine, and they're managing all the rental income, and I'm getting 8% on it. You can buy into stocks, like we said, all different companies. There you can buy in anything from telecommunications to mining to everything. MTN, Vodacom, all of them are telecommunications companies. Mining companies, Anglo, you can buy Anglo Gold, Platinum, all of these things. BHP, Sibanye-Stillwater, whatever it is you want, you can invest in these companies. You've got every single type of industry you can think of that you can actually invest in. And if you're not sure, that's when we go to something called ETFs and ETNs. So I'm going to make it quite simple. You guys can all go on our website and you can read up a lot more on what an ETF or ETN is, or you can read this entire long explanation. But ultimately, what an ETF does is an exchange traded fund or an exchange traded note. What it does is it allows you to get exposure to multiple things very, very cost effectively. What do I mean by that? Let's say you want to buy a share, you want to buy the top 40 companies, one share in each top 40 company listed on the stock exchange. It means you'd have to buy one share in Naspers, which is about 1,000, whatever, 500 Rand or however much it is. You'd have to buy another one in Standard Bank or MTN. That's 200 Rand each, most probably, around about, well, it's way below that. But before you know it, top 40 is going to cost you close on to about 20,000 Rand. That's one share in each of them. So what do? I don't have 20,000 Rand. Well, I buy Satrix 40. I can buy core shares as well, ETF. What does it do? Basically, when I buy one ETF in that, the market maker in this case, where it's either core shares, Satrix, or anyone else, actually go and then buy and make sure that I've got exposure to those top 40 companies. Now, if I have that exposure, it also means then when those top 40 companies pay a dividend, I get a percentage of that. I don't own the physical share in those companies, but I'm exposed to it. And it was probably one of the best regulated instruments around. Exchange traded funds worldwide are the largest instruments traded on in the world. Hedge funds, none of them have as much as exchange market makers and exchange traded funds have. They also have to give you a fair price because it's tracking something. So the Satrix 40 is tracking literally what we call the top 40 index in South Africa. If you invest in the S&P 500 through core shares or again Satrix or whichever market maker you want to use, you are now investing in the top 500 companies worldwide, which means you own or you have exposure, to companies like Apple, companies like Alphabet, also known as Google, Facebook, Tesla. That's literally buying one ETF. And that ETF is about 50 odd Rand. And that's the big difference. And that's why exchange traded funds are so popular and so good. And the nice thing of exchange traded funds is because they are so well diversified, they give you nice, good, steady growth over time. It's tracking the market. And that's when we get into risk versus return. You've got to understand that in everything in life, the higher the risk, the greater the return. But remember, there's also a downside to that. The higher the risk, the greater the loss. So you want to always make sure you're managing risk, and you've got to understand your own risk. So not just the risk of where the markets are. So for example, obviously cash is a much lower risk putting your money in cash than in shares. But like we just said, if you put your money in cash, you're earning 4% interest. Right? Shares, just in one company like Redefine, forget the share growth, so forget the price increasing of that share. Redefine is paying just an 8% dividend yield. I'm getting 8% there. But there's a plus and a minus to it. If I have another pandemic and we're all, again, staying at home, well, Redefine's not making income again on property because it's not able to rent its property out. Everybody's working from home. Then the share price will fall. So that's a bigger risk, but I'm still getting a much better return from it. It's a lot more stable though as well. That's what you need to decide upon. You need to sit down and you need to figure out what it is you're looking for from a reward point of view, and also how much of risk you're willing to take. If you are right now taking money out of your bond or out of your, I don't know, car payments that you need to make or anything else, and taking that and sticking it into the stock market or into trading, well, then you are in deep, deep trouble. This is money that needs to come in from a savings point of view. Money that you're not going to need, because this is going to be money you're only going to need in 5 or 10 years' time, and that's investing. You cannot be risking the money you need to put food on the table. You cannot be risking money you need to pay for your car, because your car's going to get repossessed. Then you're going to have a bigger problem. Okay? That is what you need to now sit down and figure out where you're going to be on that curve. And you need to start deciding that now. The most important thing about risk management is diversification. And that's the reason why everybody starts out, when you start investing with exchange traded funds, because it gives you the diversification immediately. What do we mean by diversification? quite simple. It's literally don't put all your eggs in one basket, right? So if I've got every single month, I want to invest, let's say, 2,000 Rand a month into the stock market. Do I take 2,000 Rand every single month and just throw it into MTN? No, I don't. Because if I do that, something happens in Nigeria with MTN again. And MTN share price goes from literally 160 odd Rand. It'll plummet down again to below 60 Rand. Right? We've seen, I mean, the best example I can actually use right now for diversification is our current market right now. Markets around the world have been plummeting, things have been dropping, and everything else. But if I have something like Satrix 40 and the likes, you'll start noticing that, well, that's not actually falling as much as just the individual shares. Why is that? I'll give you a good example. If you look at year-to-date returns, let's take British American Tobacco. It's one of the defensive stocks. And if you look at their return compared to Nasdaq's return year-to-date, well, it's pretty much incredible, the comparison. The one is pretty green, the other one is very, very red, as we would say. So if I owned a bit of Naspers, if I owned a little bit of British American Tobacco, if I owned a little bit of even gold shares, and you can buy an ETF in gold, by the way, or even platinum. Suddenly now I've got a bit more diversification. And suddenly I'd be seeing a much better portfolio. And that's the point of diversification. When something is going down, something is going to go up. Because people, like I just said in the beginning, proper investors don't take their money out of the stock market. If they invested in Naspers and Naspers starts falling and they see that there is a trend that this is going to continuously go down, they'll cash out the investment, they'll sell Naspers, but then they look and they buy something else. Everybody's heard the term, when markets are very rocky, go into safe haven assets like gold. And that's what actually happens. And that's the reason why people that are in the market for a long term are actually so successful. We all know our Elon Musk fan, the man who goes and buys things like Twitter and do stupid things like that. But everybody says that he's the wealthiest man in the world. Why is he the wealthiest man in the world? Does Elon Musk actually have, 42 billion or whatever it was that he paid for Twitter? Did he actually have that money, cash sitting in his bank account? No, he doesn't. The reason why Elon Musk is the wealthiest man, and then every so often maybe Bill Gates overtakes him and the likes, is because they own shares in companies and it's their portfolio. Their portfolio is worth that much. So Tesla shares, when it was at $1,000, made him the richest man. If it falls to below $600, he'll drop from number 1 to maybe number 5. That's exactly how it works. But they are making their money through investing in the stock market. And they don't just have an investment just in Tesla. Every single person has investments in other companies as well. Warren Buffett, one of the most famous people around, he's got investments from Hathaway. I mean, his Hathaway group has investments in Coca-Cola. It has it in all these different companies. And one of the scariest things he said is when he dies, the advice that he leaves to his estate is take all the money and invest it in the S&P 500 ETF. He said it will outperform anything else. And there you go. That's from a billionaire. But the problem that we have in South Africa is not just the investing side. The problem we have is another risk. Procrastination and excuses. The market is at a high. We love saying that. The market is way too high. The market is falling. I'm going to hold on. Let it get to the bottom. I can tell you right now, in 15 years of my life, I have never, ever bought a share at the lowest price. I have never, ever bought a share when it's even close to the low. I've always been somewhere between the low and the high. In fact, most people, the day you buy the share, and I promise you this will happen, the minute you start buying, the very next day, if not the same day, after you've placed that buy order, the share price will go down. The thing to understand is that you're in there for the long term. You're buying a company which is of value. But we love saying that the market is high and then we're waiting for it. And then the next thing we know is we're pretty much at the highest point of the market, and then we again, and the market is setting record highs again. And we've missed out. So then we don't invest because we're still waiting for the market to come down because it's too high. Then when the market is falling, we say, oh, no, I'm waiting for it to reach the low. And before we know it, the market has turned. I mean, I'll give you a very good example. I was actually, when I was doing this presentation, I was looking back at one of my very, very older presentations where we teach people how to invest. I mean, we were doing literally a 4-hour seminar back then of taking you through proper investing and trading. And in there, I had the share prices of certain companies. And this is not even 10 years ago, just by the way. And I had share prices in there. And one of the things I noticed was just looking at the all share index. That takes into account all the companies listed on the stock market. The all share index was at 32,000 points. Today, it's at 69,000. It's been up to 76,000 even. So literally in that time frame, it's doubled. So if I bought Satrix 40, literally, whatever I've put into there, it's already doubled. I can guarantee nobody here sitting in this room can say that their RA or anything else has doubled in that time. And that's just an ETF. That's not taking into account dividends or anything else, just the price has doubled. And if you were in 2008 buying Satrix was actually at an all-time high in the beginning of the year at 30, I think it was about 32, 33,000. I can't remember the exact price. And everybody knows 2008, the entire market collapsed. By the end of the year, the all share index was at about 25,000, 23,000, somewhere there. Share prices was falling. Now, if you bought it at the high and weren't listening to everybody saying to you, oh, the market's at a high and everything else, if you bought it literally at 33,000 even, today you're still at double. So don't worry about whether the market is at the high or the market is falling. The big question is, you're investing, find the right company to invest in. In fact, when the markets are falling, like now, investors are buying. So if you want to know when's the right time to buy, if you haven't, buy now. You're not going to buy at the low. I'm telling you that right now. But you're going to be buying at a really good price because there's some seriously good value out there right now. Okay. Then the other ones we come up with, this month is tough. I'm going to wait for next month. Every month is going to be tough. If you think this month is tough, what's going to happen next month? We've got an increase in fuel price of over 3 Rand. We've got inflation going really and truly skyrocketing high. We've got we've got oil prices going up. So that means all your cooking oils and all of these things are going up in price. You've got interest rates going up. So all of you with your home loans and cars, especially the cars, you guys are going to be paying more. So next month's going to be even tougher. I hope you already started saving. And I hope you started investing. Then the thing I love is waiting for that hot tip. I just always can't understand this. Why do we wait for somebody like IBs or introducing brokers or all of these people to give you a hot tip? So I've always asked this question. In 15 years, I've asked this question time and time again. If you're waiting for that hot tip, why, and if I have the hot tip, why am I sharing it with you? Do you guys see Elon Musk coming here to South Africa and going, no problem, listen, you guys want to put a flag up for 22 million Rand, don't worry, I'll give it to you. How many people do you know that actually share their wealth? So if I'm going to tell you that you can make a hell of a lot of money by buying this thing, and I start telling a whole lot of people about it, is that price actually going to go up? Or is somebody going to go, wait a minute, something's not right here, and that price is going to actually just stay where it is? because suddenly you've got all these buyers coming into a market and there's enough sellers for it. Is it really going to go up? Or is people on the sell side just going to cash in? Please stop waiting for hot tips and please stop listening to hot tips. Because what you start finding out very, very quickly is people make money when you lose money. So when somebody keeps telling you about hot tips, think very carefully about it. When somebody gives you proper research, yes, look into that. If somebody's telling you, look at this company, these are the reasons, there's these things and everything else, not technical analysis, I'm talking fundamental analysis, then start thinking about it and looking at it. Please stay away from people who are trying to sell you a quick thing and how to make money quickly. The other thing just to understand is, yes, this is a long-term investment, and therefore you can say I have time. Well, you actually don't. If you don't start now, you're going to start finding out very, very quickly that you don't have time and you're going to lose out. Warren Buffett started, and here's the thing many people don't know. Warren Buffett had a very wealthy family, so most people don't know that. So at the age of 11, he was literally, his parents were looking at trying to invest money for him. And he said he started investing at 11. And everybody was shocked to hear that. He started investing at the age of 11. The thing that shocked most of us thereafter was when he said, yeah, and I started 11 years late. What did he mean by that? He meant he had missed 11 years of growth in the stock market by the time he started investing. You're missing out on a lot of things. Okay. Last but not least, I'm sorting out my account. That's the famous one. Guys, it's just normal KYC documents that you may need to open an account. Take a picture of your ID and take a picture of your proof of address. Not older than 3 months. I know the CS team will appreciate me saying that. Okay. It's not a complicated thing to do. But you got to start investing now. And the most important thing is you got to start, like I said in the beginning, you got to start finding the right broker to go with. From a Think Markets point of view, you must probably have the lowest brokerage around. When you are buying and selling, all your shares are bought and sold on the Johannesburg Stock Exchange for now. So if you have a share account, you're buying ETFs and everything, it's in your name. It's not in anyone else's name, it's in your name. The trade is live. You also get to see a live price. So you get a snapshot so you know what you are paying for that price. You get an immediate live price. Your brokerage fee is at 0.25%. And you can do every single thing else that you want to as well. The other thing is you can, even if you're nervous and you don't want to do your investing through the app or anything else, phone us and we'll place the trade for you online. You phone us, you give us the instruction of what you want to buy or what you want to sell if you hold it already, and we will do it for you. From there, it's a simple thing. These are the type of strategies that you have in investing. Everybody will decide whether they want to go for growth or income. If you're pretty much close to retirement, you know what? It's now about getting a stable income. So you want to focus more on income. That's the difference. If you're in your early 20s and the likes, yeah, look at some growth stock shares. Balance your portfolio out, diversify it nicely. From an income point of view, it's about just having a long-term strategy. The quality of the company is important. Make sure that it's a lower risk strategy, as we call it. So you're not going to try and go and buy a penny stock, which is trading there. You're not going to go and buy Steinhoff. It's a bit of a risk at the moment. You're going to buy things like Redefine. You're going to buy things, believe it or not, like British American Tobacco and all of these type of stocks. Stable stocks, you're going to buy a lot more in ETFs as well. Growth, that's where you're going to try and buy your Steinhoffs and everything else. But just remember, balance it out. Okay. The other thing is everybody wants to know, how do I buy offshore shares? Well, ETNs can be done. Think Markets will be coming soon with an offering where you can invest directly in the US stock market. And it's going to be quite a big game changer, and we will let people know about it. But for now, you don't need to take your money offshore or anything else. You can actually buy any one of these shares literally through an ETN. And this ETNs, what they do is they track the share price. So if Tesla is going up by 20%, your ETN will be up by 20%. Okay. It's that simple. And the nice thing of investing offshore through ETFs and ETNs, it keeps your costs really, really down. Your money is still here in South Africa, but it keeps your costs down. Okay. You don't have to worry about converting it from rands to dollars or whatever currency you need to, because the banks do charge for that. So the costs are cheaper, but there you're getting your offshore exposure. You don't need to worry about it. Okay. Now, as promised, before I get into the trading side of things, very quickly, we're going to literally buy a share today. The market is closed, I know, but you're going to make the decision right now on a share to buy. And I'm going to show you how easy this is. Okay. I'm going to use myself as the example, and then we'll take it from there. So, for me personally, I sit at this moment in time, I love doing grocery shopping, and I love buying groceries from Woolworths. Okay. However, when I look at Woolworths, I think to myself, how many of us actually do shop at Woolworths? If you go to Woolworths, end of the month, the queue's not that long, right? I mean, it's, yes, fair enough. They always have that long queue because it's one queue and that there. But is that queue really, really, really that long? If I had to compare it to anybody else, if I had to go end of the month to Checkers or to Pick and Pay, are they not a bit busier than Woolworths? Well, simple answer is yes, right? Okay. The next thing then I look at is, well, actually, let me just try and understand something. Why would it be busier? Why is Checkers and Pick and Pay so much busier than Woolworths? The answer is quite simple. Woolworths is perceived as more of your luxury brand, right? It's the type of store we go to where we want to buy nice things. I don't see anybody going into a Woolies just like that to buy all their cleaning stuff and everything else, do the entire month in groceries. You may do one or two things from them because they have it on sale, but that's not the store you're going to. And besides, Woolworths also don't keep all the Simba crisp that we all love. There's no Mexican chili in that there. You have to buy prawn cocktail. Okay. It's not the type, prawn cocktail is not the type of crisp that you can put into a nice sandwich with cheese on it and you have that bread and cheese sandwich, right? That we all. So that's the thing. Much bigger variety in Checkers and Pick and Pay from a grocery point of view. Okay, so it's going to be busier. So if I'm investing and I decide that I want to invest in one of those, in that sector of food and the likes, am I going to choose Woolworths or am I going to rather look at maybe Checkers and Pick and Pay? I'm going to look at Checkers and Pick and Pay. The other thing we also have seen over the years is Checkers and Pick and Pay have been doing well. Checkers is actually listed as ShopRite, have been performing quite well. And here's the scary thing. During times when times are tough, which we are going into right now, times are going to be tough. We know that. There is one thing, though, that we all still need to do. No matter what, we're going to have to eat, right? And if we're going into tough times, am I still going to be buying all the luxury items and the likes at Woolworths? I'm going to cut down a bit on that, but I still have to buy some food and everything else. So where am I buying? I'm buying at Checkers or Pick and Pay. The last bit of that is to decide which one of those do I want to buy? Which share do I want to invest in there? Is Checkers better than Pick and Pay? At this moment in time, from the research I've done and the likes, I'm buying Checkers at the moment. ShopRite, sorry. I'm buying the ShopRite shares. They've been looking good. There's some good value in there. They've also been really and truly, a lot of people have seen on the news lately, they're actually reinvesting in their staff, giving their staff shares in ShopRite. So they're investing in their staff and the likes. It is a really good company right now, and it is the one that I would buy. That's my opinion. Okay. But that's how easy it is to make an opinion. Decide the sector you want to be in, mining, food, wherever. Find the best company in that sector and buy it. The rule of thumb is quite simple. At the end of the month, and everybody's going to get paid soon. What are we on? We're on the 21st. So the end of the month is coming. We're all going to get paid. I tell my staff this, and I will tell you this as well. Put a future dated payment or a recurring payment from your bank account on payday. put it in, and let that recurring payment go off to your stock brokering account. Don't do debit orders, do a recurring payment. Whether that be 2,000 Rand, 1,000 Rand, 5,000 Rand, a million Rand, whatever it is, put the recurring payment on. The minute you get paid, take it out and make sure it goes into your stock trading, your stock brokering account. Then go in and decide what to buy. If you're doing 1,000 Rand a month, then make sure for the next 6 months or even the next year, start buying an ETF. You can, for the first 6 months, maybe buy just Satrix 40. The next 6 months, buy the S&P 500. There you've got local and offshore diversification. If you want to, there is a webinar on YouTube under Think Markets. Just go under SA Investing. You'll see I actually take you through how you can actually do it every single month. But if you don't start doing that right now, in fact, every one of you, if you're on the webinar right now, you're in front, grab your phone out, go onto your banking app, and on the banking app, you'll actually be able to see, you can load a recurring payment or a future dated payment, whatever the bank calls it, and load it and let it start going through. We bank with Standard Bank, so just remember it's going to take 1 or 2 days if you don't bank with Standard Bank to come through to us, and make sure that the minute the money's in, go and buy. Don't wait. Okay. So let's get into the fun stuff, trading. Like I said today, I've spent a lot of time more on the investing side, and on trading side, I'm going to highlight a few things. The first thing about trading is this, and I want every single person, if you're on this webinar, if you watch this webinar again, this is the most important rule of trading. If you are starting out, do not follow the person on Instagram, the person on Facebook, and everywhere else, and dive into FX trading. FX is the highest risk of trading, and you find at least 90% of people, when they go into FX trading, lose money. All those people that are on Instagram and everywhere else that are telling you what to buy in the FX markets and the likes, again, that's your hot tip. Just think about it carefully. They're making money when you lose money. We offer FX, we are offering FX trading as well, but the FX trading is something that should come last. First, you're going to have to spend time creating a strategy. So you're going to spend time with this entire circle here and making sure every single piece of item here is ticked. Once that is done, you're then going to go and you're going to read this slide as well. You're going to spend time and you're going to start understanding how the market works. You're going to start testing the plan and your strategy as well. But the most important thing is you're going to start right at the bottom of this triangle with CFD shares. You're going to start with local CFD shares. You can move on to offshore CFD shares. Indices, commodities, precious metals, then comes the FX, and then comes the CFD cryptos. But if you start at FX, I will guarantee you right now that you are going to be around in this market for a month. Please start at CFD shares and build your way up. If you are 25 years of age, younger, actually let's make it, if you are below the age of 30, the first thing you should have been doing is already starting that reoccurring payment into your share account and start investing every single month. If you're going to dive into FX trading, you're going to start losing interest in the market because you're going to lose money. And then you're not going to come back. And then you're not going to end up in any way whatsoever actually creating some form of wealth. Start with CFD shares. And let me explain CFD shares. So with Think Markets, yeah, we've just launched now. I mean, I think we have the largest available CFD shares in South Africa. From a broker point of view, you can trade in over 2,500 US CFD shares. There's close on to now 100 SA shares as well. But at the beginning of this thing, I said to you, I'm going to show you today how you can even hedge yourself. So when it comes to CFD shares, the nice thing of it is the margin requirement there is quite low. So if a share price is 100 Rand, with the local one, it's only 20% you're putting down. So you're putting down 20 Rand and you're exposed to a share which is 100 Rand. If the share price goes up in 1 Rand, you make 1 Rand. If it goes down in 1 Rand, you make a 1 Rand loss. But that's the nice thing of it. And you can buy Satrix, 40 CFDs and everything else. So how do I hedge using CFD shares? We've got, in my portfolio, I'll use mine even as an example. I own Naspers shares. I do own them. I've kept them for quite a while and the likes. But what I started noticing is that, man, Naspers seems to be taking quite a bit of a knock at the beginning of this year. But do I want to sell my Naspers shares? No, I don't really want to. I was caught in two minds at that moment in time. I saw it going down and I wasn't too sure where the bottom was. So I decided to put a stop loss in where I was happy with on my shares. Actually, I put a share alert in rather because I didn't want it to trigger. I wanted to just see what would happen. And what I did is I took literally the value of my shares, whether it was 10,000 Rand or 100,000 Rand. Let's say it's 10,000 Rand. I literally took 2,000 Rand, put it into my CFD account, and I went short Naspers. I just hedged my 10,000 Rand portfolio. So if the share price was going down, I'd make a loss on my shares. But with my 2,000 Rand, I'd be making a profit. And that's hedging. And then I can decide what I want to do. So instead of me making a rash decision and just saying, right, close out the Naspers position, I rather did that so the hedge was there covering me. Once I was done and I really decided, you know what, Naspers, time to close out my Naspers holdings, I did that. And then I could close the hedge out as well. But I only needed 2,000 Rand because of the margin requirement. I could get the same exposure for it. But the thing is, it's CFD trading is not for the long term. It's there for the short term. I mean, I held it for just over a week. And in that week, I could now make a really good decision on what I want to do with my investment portfolio. South African CFD shares, if everybody listening here wants to know, is actually, well, CFD shares in general, is actually traded in South Africa the best. And what do I mean by that? The most profitable traders are CFD share traders. The long-term traders are CFD share traders. And what do I mean by long-term traders? I mean being around for long-term. We've got clients, I mean myself, most people may know Simon Brown as well. Simon Brown has been around in trading for more than 20 years, and he's been trading warrants, and now he trades CFD shares. Well, he trades CFD indices more than anything now, but he used to be a CFD share trader. And he's now moved into indices, and that's where he spends a lot of time, indices and metals. But the most important thing that he does is he still keeps his share portfolio growing. Now, if you want to know more about CFD share trading and what is the best way to do this is, my advice is go to our website, thinkmarkets.com, and learn to trade, live webinars. There's something called Follow the Trader. It's with Simon Brown and Njabulo. Just by the way, Njabulo's portfolio in 2 years is up over 100% with CFD share trading only. I'd like to know how many FX brokers would tell me that and actually show me the actual proof, not of a demo account. But anyway, okay. With Think Markets, you can trade in South African CFD shares. You can trade in offshore CFD shares. You've got access to all of these things. We are the cheapest around, and you get all of those benefits. If you trade with offshore shares, by the way, if you've got, you can open up a Rand account and you can trade in those shares. There's no exchange fees for that. And somebody's going to be wondering, wait a minute, why is there no exchange rate fees in that? Well, we don't convert your money. We're not taking your money offshore. So you're getting exposure. Remember, CFD share, you're getting exposure. You don't own the share itself. So there's no impact to your offshore allowance. There's zero exchange rate fees. You can choose whatever base currency account you want. You can have a ZAR account and you can just trade it all from there. Nothing. And there's zero com on all our offshore CFD shares and indices. Like I said, follow the trader webinar. It's every Wednesday at 5:30 with Simon and Jabulo. His portfolio is up over 100% already. He's not giving you advice or anything else. What he's showing you is why he's trading a certain share and why he closes out a certain position. He gives you the technical side of things, but he also uses fundamentals so that you can start understanding how trading works. Okay. The most important thing is don't be afraid to pay school fees. What do we mean by that? Don't be afraid to make a loss. In trading, you are going to make a loss. The most important thing is you better learn from that. You better learn, and you better learn quickly. It's a short-term thing. So learn and learn as much as you can. Please do not follow people who are telling you buy this, sell this, and do this and do this, especially when it comes to FX and the likes. Okay? Learn and test your strategies and the likes out. To give you an example, CFD share trading, you can literally start with 1,000 Rand. With 1,000 Rand, you can get quite a few, you can get exposure. In fact, with 1,000 Rand, you'll get exposure to about 4 NASPA shares, maybe, say 3 NASPA shares. So remember, it's geared 5 times that, okay? So you can get quite a bit of exposure there. And you can learn from 1,000 Rand. You can make sure you set stop losses, see how it works, look at your strategy. But trade CFD shares first. Then you can move on to the rest. Okay. So cost is a very, very important thing, as we've seen. And costs eat into your investments. Now, I'm going to ask this question, and I'll actually ask if people on the webinar can just raise their hands. How many of you currently invest and trade CFD shares with your bank? If you're willing to raise your hand on the webinar, please do so. I'd love to know how many of you do that. So if you bank with FNB, you actually invest with them and you trade CFDs with them, if you with Standard and the likes, then you get silence. So the reason why I ask this question is, your bank is, I've worked in the banks. I've actually worked for all the stockbrokers in the banks. I can tell you right now, they are the most expensive. And my big question is, why are you still there? Why are you continuously willing to pay all those exceptionally high fees for the exact same thing? Your money is not safer. Your investment is not safer. Your investment, like with us, is exactly the same as with the bank. It sits, it's bought on the JSE, and it's there. When you're trading, it's the same thing. In fact, with Think Markets, the scary thing is from a trading point of view, your money's safer with us than it is at the bank. So any money that comes into our account sits in a client trust account, which is a completely separate account. I can't touch that money. Okay. If Think Markets doesn't exist today, that money's there. But the most important thing with trading is counterparty risk. Because remember, a percentage of your money that you deposit is taken and reserved as margin. So if a company goes bankrupt, then you obviously lose that margin as well. Think Markets, we've got a total of $1 million protection per client with regards to the deposits you put with us. So if you have margin with us or anything else and Think Markets is no longer around tomorrow, your margin and your deposit is protected in the account. Okay. And by the way, when you're investing with your bank is not actually your broker, just so that you know. The JSE has this wonderful rule. The JSE says that a bank cannot be a stockbroker, but a stockbroker can be owned by a bank, which means when you invest with your banks, you're still investing in a totally separate PTY limited company. And if that PTY limited company goes bankrupt or the bank decides to shut it down because it's not maybe profitable or anything else, that's it. That's your risk. And from a trading point of view, that's your risk. Okay. So I have no idea if you are still with your bank, then feel free. Just look at this slide over here and understand how much of cost you're paying and actually how much you're losing out on. And just by the way, I always say this to people, please go and look at the cost actually that you are paying when you're with your bank. because you have a monthly fee, you've got a brokerage fee, you've got a minimum fee, you've got a withdrawal fee, you've got a phone trade fee, you've got a live price fee, you've got, actually it's about 6 pages worth of fees. Enjoy. Okay. The most important thing is when it comes to trading or investing, this is the most important thing for everybody. We need to make sure that our return is important. If I'm spending 3 years and prepping and investing and everything else for something, I'm expecting a good return. Okay. The rate of inflation, you have to beat that. Your investments must beat inflation. Otherwise, it's losing money. Always understand the risk in the business. And remember, you want to try and beat the market. So if the JSE All Share is going up by 5% per annum, you need to be making 5.2%. Because if it isn't, then just buy the ETF rather. Okay. So I know I've gone a bit over on time. I'm going to just close very, very quickly with everything here. Throughout the slides at the top corner over there, there's been this wonderful barcode. If you take a picture of that barcode, by the way, it'll take you straight to the app. And you can actually download the ThinkTrader app and you can open your account immediately from there. You can open a share account or a CFD account, and thereafter you can add whichever one you need as well. You can have share accounts, you can have CFD accounts as well. My advice is have both and make sure on a reoccurring basis your investments are taken care of, and then sort out your trading as well. But that is where ThinkTrader sits. It was probably actually one of the easiest apps to use. I can guarantee you this, having been through all these apps. It is easy. For those of you that have share accounts and that there, have a tablet. If you have a tablet, Samsung, Apple, whatever it is, download the app on there. It is stunning to use on the tablet. I won't lie to you. And it is really simple and easy. Traders, if you people don't want to use our in-house ThinkTrader platform, there is MT4 and MT5, the MetaTrader platforms. I know the FX guys love those. Okay, but remember what I said. Before you get to FX, start with the shares. If you want access to 2,500 shares listed around the world, open a ThinkTrader account. You'll find them there. Okay. But there you go. That is literally plain and simple. And I cannot understand why. If you are trading CFD shares, local CFD shares, because our banks here in South Africa pretty much offer that, I have no idea why you are not with Think Markets. I've been in this industry more than enough. And like I say, I've been with everyone else. Trust me, you're not getting better value anywhere else. There's your share account brokerage, CFD account. If you want a Think Zero account, these are the FX guys. They love these things. You get literally something with raw pips. So there's 0 pips. And the commission starts at only 3.5 USD. And if you have a ZAR account, it's 50 Rand. All the platforms are most probably one of the safest and secures around. And then comes even something better. Everybody loves trading signals. We all know this, especially the younger crowd. Below 30, I need to know whether or not I should be trading. We give you that for Forex, crypto, stocks, and indices and the likes. But here's the difference, and you'll see it right now through Trading Central. Trading Central doesn't just tell you that if this goes up, I mean, this share or this FX is going up, therefore buy now. That's not what we do. We tell you where the points are that you need to look at if you need to go long. But we also tell you that if it goes the other way, then where you need to go short and where your stop losses and that should be in as well, where your take profit should be. And that's the difference than somebody sitting there going and posting on Instagrams and everywhere else saying, buy now. Last but not least, the most important thing is trust, whether or not you can trust us or not. Look, Think Markets has been around for more than a decade, and I won't lie to you, that's longer than most stockbrokers, online brokers have been around. The scary thing is, we're actually one of the most regulated here in South Africa. So when you have a complaint, you can actually do something about it. And if you have problems, you can sort it out. We have an ODP license, which is an over-the-counter derivative product license, which means we are regulated and authorized to offer all derivative products that you've seen on our website. We don't just have, I know all these brokers love advertising, they have a Cat 1 license. Well, That's quite little, but we have a cat too as well. And the reason we have that is because we can actually even manage people's funds. And we're going to be launching a wealth offering soon where we're going to help you to manage your funds as well. You've got 24/7, by the way, assistance. Our live chats are actual human beings. I promise you that. They're sitting in the room here with you. They do talk to you on live chat. So you are not talking to a bot or a WhatsApp or anything else like that. You're talking to real people, and they will help you as much as they can. 24/7 days. So we're going to go into some questions and answers quickly. If there's any questions in that there, you can type it out. Alternatively, anybody here has any questions, you can ask as well. While that slide is up, I'm now going to give the good news. So yes, you've seen on the slides, yes, we are one of the proud sponsors of Liverpool. And for everybody that has attended today, even by a webinar, on Monday, we will be making a draw and we will be contacting a winner. You're getting a signed Liverpool top. One person will get one. And just so that you know, I am the biggest Liverpool fan around, as everybody else is. Yes, we are. And yeah, you're getting a top actually signed by the current Liverpool team. And fingers crossed, touch wood, touch everything that I can find. If we win the quadruple, that top's going to be worth a lot. Not a bad investment for you, just for spending a Saturday morning listening to me. Okay, cool. Anything here from people in front? Any questions that you'd like to ask? Everybody, yes. Sorry. So if you're comparing fees, so let me explain very quickly. That's a very good question. You compared us to how we have zero commission on certain things. So first and foremost, from a share account, you're paying brokerage. Okay. Brokerage is your fee, that's 0.25%. We're just not excessive with our fees. Okay. That's the big difference. From a CFD trading point of view, there's a big difference there. So we don't put spreads in on our local shares. So when you trade local South African CFD shares, there's a commission of 0.1% there. And there's no spread. The price you pay is the price in the market. So a lot of brokers, what they do is they say no commission, but MTN is trading at 160 Rand, and then they're selling it to you at 161 Rand. So they're making their profits. And then it normally works out to about 1 to 2%. So you got to be careful of that. Okay. From a share point of view and the likes, we make money there. So US shares and FX especially, we have liquidity providers. We get a wholesale rate. And sometimes, so in other words, let's say the FX is trading at, I don't know, say 15 Rand 60. Okay. We're getting it at 15 Rand 59. So we make a once. The way we make our money is every broker, when it comes to trading, especially CFDs, they charge you what they call an overnight funding rate, called a swap rate. Ours is literally prime plus 3%, prime minus 3%. Actually, SIBOR, sorry, we are not prime, SIBOR. SIBOR plus 3% and SIBOR minus 3%. That's on the South African interest benchmark bank something I can never ever remember. SIBOR, just Google it. It'll give you the full explanation. It's the same as, so you'll see most brokers so the banks normally charge SAFI. It's exactly the same thing. SAFI is a South African futures something yield, whatever it is, but it's exactly the same. In fact, the rate we use is the more stable rate, so it doesn't fluctuate that much, and it's directly linked to the banking rate, lending rate. So it's still cheaper, but yes, that's how we do make our money on trading. From an investment point, up front, and you pay all the JSE fees. You'll see you pay the JSE fees like investor protection levy and all of those things. That doesn't come to us. That obviously goes to the JSE because you're buying shares on the JSE. Yes. No. What's my ownership? Ownership is Think Markets globally is actually owned. Think Markets is a totally separate company. We are not owned by the banks. Not a single bank has a share involved in us. and we don't work with the banks, except for having to have a bank account with them. Unfortunately, we have to. It's a real pain, but anyway, I won't say anything more about that. Okay. I'm just going to go here quickly online. Person wants to know, is there any monthly fees for CFD accounts? No, there's no monthly fee for a CFD account. There's no admin fee. There's also no brokerage on top of your commission. There is none of those fees. There's no withdrawal fees as well. By the way, your CFD accounts, we also take on the cost. If you need to use, need to deposit funds, because when it comes to trading, we know you're going to need to deposit funds quite urgently. You can use OZO, which is an instant ETF, instant EFT or bank wire, or you can use your debit or credit card to actually deposit funds in. That is done instantly. If you do a bank wire or EFT, then obviously that can take 1 to 2 days. If you bank with Standard Bank, it's same day because that's what we use. But yeah, you can use those things for trading. Your share account, you can't. Share account, you only can do via EFT. Okay, and there's no fees for that, by the way. Instant deposits, allocations, no fees for that. Will there be a recording? Yes, the recording will be available on YouTube. It will get edited, so by Monday you will be able to see the full recording as well. Okay. So is there anything else here? Or can I just finish up with these ones? Okay. Right. So again, what is the cost for a share account? As I said earlier, it's just brokerage. It's your brokerage fee of 0.25%, minimum 30 Rand. That's your brokerage cost, and you can buy all exchange traded funds and the likes. You do get access to a live price. There is no monthly fee on it. There is no, on a share account, there's no monthly fee, withdrawal fees, admin fees, or any of those type of things. There's no phone trade fee as well. So if you don't want to use your app and you're in load shedding or whatever the reason may be, or you're out of data and the likes, no problem, just phone. Okay, the numbers are available there on the website. Cool. I'm actually going to leave it there because I'm just seeing I'm quite over time. Ladies and gentlemen, as I said, for those of you on the webinar and those of you here present, you will be informed of who the winner is come Monday. All right. And please look after that Liverpool t-shirt. Like I said, it's going to be a very good investment. Quadruple on its way. Thank you, everybody, for joining, and we will catch up again soon. We will be having a lot more events and webinars, and we hope to see you there. Take care.